Welcome to the Deep Dive. We're the show that helps you cut through all the noise, really sift through the information out there, and get you those impactful insights you need. Today, we're plunging into a really vital part of inventory management. It's often overlooked, I think.
We're going beyond just, the simple idea of how much to order. We're focusing on the really critical questions. When should you order? And how much buffer do you actually need? Our mission, as always, is to take our sources, pull out the absolute core knowledge on reorder points and safety stock, and basically give you a shortcut to being genuinely well-informed on this. And speaking of getting those essential insights, just a quick word on where today's material comes from. This deep dive is based on some really comprehensive resources from Farhat lectures. All the content, the examples, the explanations, everything we talk about today is derived from farhatlectures.com. So look, whether you're an accounting student, maybe studying for the CPA exam, or even if you're a professional just looking to sharpen your skills, remember to check out farhatlectures.com. They've got additional practice questions, video lectures, detailed support, great stuff to reinforce what we cover. A big thank you to Professor Farhat for providing this valuable material for us to dig into.
Okay, so let's unpack this. It's kind of a shift in thinking, right? Many of you listening probably know about the economic order quantity, EOQ.
Yeah, the classic formula.
Right, that elegant formula that's designed to find the perfect order size. Minimize your holding cost, minimize your ordering cost. In theory, in a perfect world, EOQ is great. You order just enough, and the new stuff arrives precisely when your current stock hits zero. It's all about perfect efficiency, perfect predictability.
Yeah, and what's really fascinating there, or maybe concerning, is that while EOQ is cost optimal on paper, it makes this huge underlying assumption, a dangerous one, really,
Which is?
that nothing ever goes wrong. I mean, think about the real world. Supply chains are messy, they're unpredictable.
Right, not perfect.
Not at all. So what actually happens if your inventory hits zero, like the formula assumes, but your supplier, well, they don't deliver on time for whatever reason?
And it's not just small delays sometimes.
Exactly. We're not talking minor hiccups. We could be talking, major supply chain disruptions. Think about a big storm closing shipping routes, or maybe supplier issues like employee strikes stopping production.
Yep.
Or even bigger things, geopolitical situations that can just sever your supply lines completely. Stuff happens.
And when those risks, those real-world problems hit, the consequences aren't just a little blip. They cascade, right?
Oh, absolutely.
You're not just losing that immediate sale because you don't have the item.
No, it's much bigger than that.
You could be damaging your reputation.
Right.
I mean, customers expect you to have things. Reliability matters.
It really does. And that leads straight to customer dissatisfaction, lose that loyalty, and, well...
They might not come back. Imagine needing a part urgently.
Right.
You go to your usual place, they're out, you go somewhere else. Maybe that somewhere else becomes your new usual place.
Precisely. So it really forces this vital question for any business owner, anyone managing inventory. How do you actually protect yourself? How do you guard against these unpredictable nightmares without, totally blowing your budget on holding costs?
Okay, so this is where we pivot, right? We move away from just pure theoretical efficiency and towards, well, practical resilience. How do companies build in that cushion, that buffer you mentioned, against these unpredictable delays to make sure things keep running smoothly? Because let's face it, the world is rarely as neat as an EOQ formula suggests.
You've nailed it. This is exactly where the concept of safety stock comes in. It's indispensable, really.
So define that for us. What is safety stock specifically?
Safety stock isn't just, extra stuff you happen to have. It's a strategically maintained buffer. It's an additional quantity of inventory that you hold specifically, intentionally, to guard against those unforeseen delays in supply or unexpected spikes in demand.
Okay.
It's basically your operational insurance policy.
An insurance policy. I like that. What are the core benefits then? Why have it?
Well, the benefits are pretty clear, and they directly tackle those risks we just talked about. First, it's about mitigating risk. Plain and simple.
Right.
You're not just hoping for the best. You're actively prepared for when things inevitably don't go exactly to plan.
Okay, makes sense.
Second, it ensures smoother operations. Think about manufacturing. If you have that buffer of raw materials, your production lines keep humming even if a key supplier misses a delivery date. No costly shutdowns.
Crucial for production.
Absolutely. And third, maybe most critically, it keeps your customers happy.
Back to the customer.
Always. By having that buffer, you can consistently meet demand on time. You build trust. You avoid those horrible, sorry, we're out of stock conversations that just send people straight to your competitors.
Yeah, nobody wants to hear that.
So think of it as an investment in consistency, in reliability, in customer satisfaction.
Okay, so if we all agree that hitting zero stock is playing with fire, and we need this strategic buffer, this safety stock, then the next logical question is when? When exactly should a business pull the trigger and place that next order?
Right.
That brings us to the reorder point, I assume.
That's it exactly, the reorder point. It's your signal. It's simply that specific inventory level that tells you, okay, time to order more.
It makes sure you get the new stuff before you run out completely.
Precisely. To make sure the new shipment arrives before your current inventory, including any safety stock you've decided to hold, is depleted.
Okay, so how do we figure that out?
Yeah.
The basic calculation.
Well, the basic calculation, going back to that kind of perfect world scenario for a moment.
No delays, right?
No delays, steady demand. It's pretty straightforward. You take your daily usage, how much you use or sell per day, and you multiply it by your supplier's lead time.
Lead time being how long it takes them to deliver after you order.
Exactly. The time lag between placing the order and receiving the goods.
Okay, let's use an example. That always helps.
Sure. Let's imagine your business uses, say, 50 units of an item every single day. Nice, steady demand.
Okay, 50 units a day.
And let's say your supplier, once you place that order, consistently takes 10 days to get the new inventory to your door. That's your lead time.
10 days. Got it.
So your basic reorder point calculation is simply 50 units per day multiplied by 10 days lead time.
Which is 500 units.
500 units, exactly. So in this perfect world, when your stock level drops down to exactly 500 units, that's your trigger. Place the order then.
And the idea is, over those next 10 days, you'll use up those 500 units.
Right, 50 a day.
And just as you hit zero, bam, the new delivery arrives. Perfect timing.
Perfect timing.
Yeah.
It's like a beautifully choreographed dance, theoretically. Efficient, yes, but leaves absolutely zero room for error. No buffer for reality.
Which brings us back to reality. What happens when that perfect world scenario doesn't happen?
Yeah.
Which is, let's be honest, most of the time.
Pretty much always, yeah.
How do we actually build in that margin for error?
Yeah.
For those potential delays, those bumps in the road we talked about, how does safety stock fit into the reorder point calculation?
Right. This is where we get really practical. To figure out how much safety stock you actually need, you can't just guess. You need to look at your history. You analyze past delivery performance from your suppliers. How often were they late? By how much? You also look at demand variability. Were there unexpected spikes? You try to identify your worst-case scenarios.
Like the longest delay you've ever had.
That's often a good starting point, yeah. What's the longest historical delay you've seen from this supplier? Or maybe what was the biggest unexpected surge in demand you had to cover? This helps you quantify how much extra buffer you really might need.
So how do we calculate that buffer quantity, the safety stock itself?
Well, a common way to calculate it, keeping it understandable, is to again use your daily usage, but this time multiply it by the number of extra safety days you think you need protection for.
Based on that historical worst-case delay, for instance.
Exactly, based on that analysis. Now, it's worth pointing out, that while using the longest historical delay is practical, especially maybe for smaller businesses, larger companies often use more sophisticated statistical methods. They'll actually measure the standard deviation, the variability in both demand and lead time.
Okay, getting fancier.
Yeah, they aim for a specific service level, like saying, we want to be able to fulfill 95% or 99% of orders on time, even with variability. But for our purposes today, just understanding you're buffering against those extra potential delay days is the key concept.
Got it. Let's stick with our example then. Daily usage was 50 units.
Right, 50 units a day. Now, let's say your historical analysis shows the absolute longest delay you ever experienced from that supplier was an extra 5 days, beyond the normal 10-day lead time.
Okay, so 5 extra days is our worst case.
Let's use that. So your safety stock calculation would be 50 units per day multiplied by those 5 extra safety days.
50 times 5.
250 units.
250 units. That's your safety stock. That's your buffer against that worst-case delay.
Okay, so we have the basic reorder point, 500, and the safety stock, 250. How do they come together?
Simple addition. To get your revised reorder point, the one that actually accounts for real-world uncertainty, you just add your calculated safety stock to your basic reorder point.
Oh.
So in our example, basic reorder point was 500 units, 50 units a day by 10 days. Your safety stock is 250 units, 50 units a day by 5 extra days.
Right.
Your revised reorder point is 500 plus 250 equals 750 units, not 500.
So now you place the order when your inventory hits 750 units, not 500.
Exactly. That gives you that crucial 250 unit cushion. If the supplier delivers on time in 10 days, you'll have used 500 units, and you'll still have the 250 units of safety stock left when the new shipment arrives.
But if they're late, say by those full 5 extra days.
You'll use up that 250 units of safety stock, and the new shipment should arrive just as you hit 0. You're covered. You avoid the stock out.
That makes so much sense. It shifts from just efficiency to actual resilience.
Yeah.
But there's always a but, right? This brings us to the trade-off.
Always a trade-off in business.
Holding this extra 250 units to safety stock, it costs money, doesn't it?
Yeah.
Storage space, insurance, maybe the product could expire or become obsolete, capital tied up.
Absolutely. There are definite carrying costs associated with safety stock. You're right. Storage, insurance, obsolescence risk, the cost of capital tied up in that inventory. It's not free.
So it sounds like a good idea, but is it always worth the cost?
That's the core question.
Yeah.
And the philosophy I've seen work, the one that successful businesses tend to adopt, is that the cost of not having that cushion, the cost of a stockout, is almost always far greater than the cost of carrying a reasonable amount of safety stock.
Explain that, the hidden costs.
Exactly. Think about the true cost of running out. It's not just the profit margin on the one sale you missed right then.
Okay.
It's potentially the entire lifetime value of the customer who went elsewhere and might never come back.
Wow, yeah.
It's the cost of maybe having to pay for expedited shipping to rush in replacement stock at crazy high prices. It's the damage to your brand's reputation for reliability that's incredibly hard and expensive to rebuild.
Yeah.
It's even the impact on employee morale. Your sales team is frustrated. Customer service is dealing with angry calls. The ripple effects are huge. The actual cost of a stockout can easily be 5-10 times the value of the lost sale itself, but companies often only track that immediate hit.
That's a really important point. We focus on the carrying cost because it's visible on the balance sheet, but the stockout cost is often hidden but much larger.
Precisely. But on the flip side, you also don't want too much safety stock.
Right, there's a balance.
There has to be. Holding excessive inventory ties up way too much capital that you could use for growth, R&D, marketing. It dramatically increases those storage costs, and for anything perishable or, say, fashion-related, the obsolescence risk becomes massive.
So finding that sweet spot is key.
It is. The goal isn't just have safety stock. It's have the optimal level of safety stock enough to provide the protection you need at an acceptable service level without incurring excessive holding costs. It's a continuous balancing act, an optimization challenge.
Okay, that really clarifies the strategic thinking behind it.
Yeah.
It's not just a simple calculation. It's a risk management decision.
Very much so.
So let's pull this together. What does this all mean for you listening right now? Beyond these inventory numbers, we've kind of gone on a journey, haven't we?
We have.
From that neat, clean, theoretical world of EOQ to understanding this critical, real-world necessity for reorder points and especially safety stock. These aren't just, dusty concepts in a textbook.
Not at all.
They are vital, practical tools. Tools for navigating the bumps, the uncertainties that are just inherent in managing inventory and running a business. They help you stay agile, stay responsive.
And, if we step back even further, connect this to the bigger picture, this whole philosophy, having a cushion, having that extra safety margin, it isn't just for inventory.
Interesting. Go on.
I mean, it's really a valuable principle for life, isn't it? And for business strategy in general. Think about it.
Yeah.
Having extra savings for an unexpected car repair or medical bill.
Like a personal safety fund.
Exactly. Or being overprepared for a really important exam or presentation.
Reducing anxiety, increasing confidence.
Right. Or, in business, building redundancy into critical systems, not just inventory. Having that buffer, whatever form it takes, it brings peace of mind. It builds resilience.
It's the difference between constantly reacting to fires and proactively making sure the fires don't start, or at least don't spread, protecting what you've built.
Well said. It truly doesn't hurt to be prepared.
Absolutely. That's a powerful takeaway. It's about strategic preparation being an investment, definitely not just a cost. So we really hope you take this knowledge and think about how to apply it. And remember, for more on this, for practice questions, video lectures, tons of resources on finance, accounting, CPA, CMA exams, check out farhatlectures.com. It really is an investment in your own knowledge, your preparation, and like we said, your own future resilience. Thank you so much for joining us on this deep dive. Stay curious, everyone. Stay well informed, and we will catch you on the next one.